In the last few weeks, the crypto market has been on a wild ride, touching all time highs before seeing sharp, sudden drops. $1 trillion in value seems to appear and vanish overnight. But this isn't just another dip or a typical Saturday sell off. We could be in the early stages of a massive deleveraging event that is creating a severe liquidity crisis. What we're seeing right now isn't a normal market correction, it's fundamentally different from the bull market shakeouts of 2021. The very structure of the market is under duress. Stick with me for the next few minutes, and I'll explain exactly what is happening, why it's happening, and what this volatility could mean for your portfolio. We're going to connect the dots between central bank policies, hidden risks in the derivatives market, and the massive sums of money now whipsawing through the space. This is the story of how the crypto market is being tested like never before. To truly understand the scale of what's happening, we need to look past the simple red and green charts and talk about two critical concepts: deleveraging and liquidity. These aren't just Wall Street buzzwords. They are the invisible forces currently tearing through the digital asset ecosystem. First, let's talk about deleveraging. Imagine the crypto market as a series of interconnected Jenga towers. For the past year, traders have been adding more and more blocks to their towers, but not always with solid capital. They've been using leverage, borrowed money, to build higher and faster. This works spectacularly on the way up, amplifying gains and creating a euphoric rush. But when the market turns even slightly, the entire structure becomes dangerously unstable. A deleveraging event is what happens when those towers start to wobble. A lender, like an exchange, gets nervous and issues a margin call. When thousands of traders face this at once and can't add more funds, the exchange forcibly sells their assets to cover the debt. This forced selling pushes prices down further, which in turn triggers another wave of liquidations for other leveraged traders. It's a vicious cascading cycle, and the scale of these cascades can be staggering. We've seen this play out repeatedly. In early November 2025, the market saw $1.27 billion in long positions forcibly closed. On November 11th alone, another $244 million in long positions were liquidated in just 24 hours. In another instance, as Bitcoin briefly dipped below the key $100,000 level, over $117 million in long positions were wiped out in a single hour. This brings us to the second, and perhaps more dangerous, part of the problem: the liquidity crisis. If deleveraging is the fire, a lack of liquidity is the gasoline poured on top. So, what is liquidity? The simplest analogy is to think of the market as a giant swimming pool. In a healthy liquid market, the pool is deep and full of water. Large buyers and sellers can jump in and out without causing massive waves. You can execute a large order without drastically affecting the price because there are plenty of participants on the other side of the trade ready to absorb it. Right now, the crypto market's swimming pool is showing signs of draining. While the total crypto market cap remains high at over $3.5 trillion, the buy side liquidity can vanish in an instant. When a large seller, like a whale or a fund that's being liquidated, needs to offload their assets, there aren't always enough buyers to soak up the supply. The result is that even a moderately large sell order can create a tidal wave, crashing prices disproportionately. This is the situation we are in today. A massive forced deleveraging event is happening inside a market that is simultaneously suffering a severe drought of buyers. The system gets clogged, the water drains, and the chain reaction of liquidations can spiral out of control. So, what lit the match? Why is this happening now? This volatility wasn't caused by a single event like the collapse of an exchange. It's the result of a perfect storm where multiple powerful forces converged at the exact same time. We can break these down into three main categories: macroeconomic headwinds, a shifting regulatory landscape, and revealing on chain market dynamics. Let's start with the biggest factor, the one that's outside of crypto's control: the macroeconomic environment. For the better part of 2 years, crypto and other risk assets have been propped up by the promise of cheap money, but that era is definitively over. Central banks, led by the US Federal Reserve, have been signaling a higher for longer stance on interest rates to combat inflation. Rising borrowing costs put immense pressure on speculative assets like crypto. When you can get a decent, low risk return from government bonds, the incentive to gamble on volatile assets diminishes significantly. Tough talk from central bankers and fading hopes for near term rate cuts have prompted investors to pull back from riskier assets. The second major catalyst is the shifting regulatory landscape. For years, the crypto industry in the United States has operated in a gray area, caught between the jurisdictions of the SEC and the CFTC. That ambiguity is now starting to resolve, but the process is creating intense uncertainty. On November 11th, 2025, the Senate Agriculture Committee released a new bipartisan discussion draft for a crypto market structure bill. This bill aims to finally clarify which agency regulates which type of asset, proposing that decentralized cryptocurrencies would fall under the CFTC, while tokens linked to specific entities would be handled by the SEC. While long term clarity is a positive, the short term effect has been to trigger repositioning and fear. Adding to this, the CFTC announced that leverage spot crypto trading could be coming to US exchanges as soon as December 2025, forcing traders to adjust their positions and adding to the price swings. Furthermore, there are signs of a new approach at the SEC, with discussions around a token taxonomy to better classify digital assets. This period of regulatory flux has directly contributed to the volatility. The final piece of the puzzle is the on-chain evidence. We can see exactly how the market's internal structure buckled under this pressure. One of the most telling signs is the Crypto Fear and Greed Index. This tool measures market sentiment on a scale from 0 to 100. Recently, the index plunged deep into extreme fear, hitting a score of 15, a low not seen since the 2022 bear market bottom. When fear is this high, investors are more likely to sell irrationally, and potential buyers are too scared to step in, further exacerbating the liquidity drought. So when you combine tough central bank policies, major regulatory shifts creating uncertainty, and on-chain data showing the market plunging into extreme fear, you don't just get a correction, you get the perfect storm that we are living through right now. Look, I know this is a lot to take in, and the market is moving incredibly fast. The data we've just gone through, the liquidation cascades, the macro pressures, the regulatory shifts, paints a complex and, frankly, a concerning picture. Understanding these deeper mechanics is the only way to navigate this environment without making emotional decisions. It's about separating the signal from the noise. If you want to stay ahead of these trends and get this kind of in-depth analysis delivered directly to you, I highly recommend signing up for my free newsletter. It's where I share my weekly research, key charts I'm watching, and my thoughts on where the market is headed next. It takes 5 seconds to sign up, and the link is right below in the description. It's the best way to support the channel and ensure you don't miss critical insights in times like these. Don't just watch the market swings happen, understand why it's happening. The link is in the description. Now, let's get back to why this time is different. We've seen crypto crashes before. We survived the 2018 winter and the earth-shattering collapse of FTX. So it's natural to ask, what makes this one so different? The answer lies in the nature of the contagion, and the source of the problem. Previous crashes were largely internal affairs. The FTX collapse, for example, was a story of fraud and contagion contained almost entirely within the crypto ecosystem. The problem started inside the house. This crisis is different because the primary drivers are external. This isn't a case of one bad actor bringing the system down. Instead, the system is being squeezed by powerful macroeconomic forces that the crypto market is powerless to influence. The Federal Reserve's monetary policy and rising global interest rates are setting the tempo. For the first time in a major downturn, crypto is acting less like an isolated digital frontier and more like another class of risk assets, just like tech stocks. This is also the first major crash in the era of spot Bitcoin ETFs. While these ETFs have been a massive success, they have also created a new vector for volatility. The flow of money into and out of these products is now a dominant force in driving price. We've seen a stark example of this just this week. On Tuesday, Bitcoin ETFs saw a massive inflow of $524 million, their strongest day since early October, with BlackRock's IBIT ETF alone absorbing over $224 million. But just a day later, the trend completely reversed, with US spot Bitcoin and Ether funds posting significant net redemptions. This creates a dynamic we've never seen before at this scale. The crypto market is now subject to the whims of institutional portfolio rebalancing. When traditional fund managers get nervous about macro data, they can now sell their crypto exposure as easily as they sell stocks, creating huge correlated sell-offs. The ETFs provided a bridge for massive capital to enter, but they also built an express lane for that same capital to exit. Another key difference is the nature of the leverage that was just flushed out. The contagion isn't just spreading from one lender to another, it's cascading through complex hedging strategies and collateral adjustments on futures platforms. This makes the deleveraging process more violent and unpredictable. Finally, what's different this time is that the market structure itself is showing signs of being stronger, yet also more brittle. While analysts note that the level of leverage appears lower than at past euphoric peaks, the system's reaction to the liquidity drain has been severe. The sheer speed and violence of the price drops, triggered by external factors, show a new kind of fragility. The market has matured enough to be connected to the global financial system, but it may not be mature enough yet to withstand the shocks that come with that connection. The big question on every investor's mind is, where does it go from here? Is the worst over, or are we on the precipice of a much deeper fall? Understanding the implications of this liquidity crisis gives us a roadmap of what to watch for. The most immediate implication is for altcoins. In a flight to safety, capital doesn't just leave the crypto market, it also rotates within it. Typically, money flows from riskier altcoins into the relative safety of Bitcoin, and then from Bitcoin into stablecoins or fiat. We are seeing this play out in real time, with Bitcoin's market dominance strengthening to nearly 60% as investors seek safety. As liquidity continues to dry up, smaller projects will face an existential threat. The next domino to watch is the health of stablecoins and the DeFi lending markets. Stablecoins are the bedrock of crypto liquidity, and any hint of instability there could trigger a systemic crisis far worse than what we're currently seeing. Keep a close eye on the reserves backing major stablecoins, as well as the lending rates in major protocols. Then there are the key technical levels for Bitcoin, which will act as the ultimate litmus test for market sentiment. As of now, Bitcoin's price is consolidating in a volatile range. After hitting a high above $124,000 in October, it has seen pullbacks to below $100,000. The psychological level of $100,000 is the key battleground. A sustained break below this support could trigger another major wave of panic selling. Some analysts see a potential range between $97,000 and $111,900 until a clear catalyst emerges. Conversely, the key resistance level to watch on the upside is a decisive break back above the recent highs near $112,000 to $114,500. A move above this area could signal that the worst of the selling pressure is over, but until that happens, every bounce is suspect. Beyond the charts, the most important indicators to monitor are the very forces that cause this crisis. First, watch the ETF flows. Are institutions starting to buy the dip, or are outflows continuing? Daily ETF flow data will be a crucial real-time indicator of institutional conviction. Second, pay close attention to statements from the Federal Reserve. Any hint of a policy pivot will have an outsized impact on the crypto market. Finally, continue to monitor on-chain data. Look for a recovery in the fear and greed index out of extreme fear territory. These are the green shoots that will signal a genuine bottom is forming, rather than just a temporary bounce. So let's bring it all together. The volatility we are witnessing is not just another dip. It is the painful consequence of a market confronting a new reality. It is a full-blown liquidity crisis, ignited by a perfect storm of external macroeconomic pressures, unsettling regulatory shifts, and a cascading deleveraging within the derivatives market. We've seen how tough central bank policies created an environment hostile to risk assets. We've seen how this pressure triggered waves of forced liquidations, wiping out billions in leveraged bets. And we've explored why this time is different. It's a crisis driven by external forces, not internal fraud, and it's happening in an era where institutional ETF flows can amplify volatility in both directions. The road ahead is uncertain. The crypto market has been fundamentally stress tested, and its interconnectedness with the global financial system is no longer a theoretical concept. It is a tangible and painful reality. While long-term bulls may point to the flushing of leverage as a healthy reset, the immediate future will be dictated by forces far beyond crypto's control. The story of how the market rebuilds, adapts, and survives in this new paradigm is just getting started. The key is not to panic, but to understand the deep-seated forces at play. Thank you for watching.